Hello and welcome to an exciting session today where we're going to talk to one of the smartest Pakistanis in the world when it comes to watching, understanding, and explaining macroeconomic trends. Uh, they say there are decades when nothing happens and weeks when decades happen. We're certainly living through those weeks at the moment with Russia's invasion of Ukraine, with the Fed about to hike interest rates, easy money, the era of easy money about to end, inflation spiking. What does all of this mean? Where should you be investing your dollars or rupees? What does this mean for startups, for startup valuations, and for fundraising? We've got a big startup community here. And what does this mean for Pakistan? And how will this impact Pakistan's economy, our foreign exchange reserves, our stability, and as well as the potential risk of a sovereign default. We're going to cover all of this with Dr. Salman Ahmed, who's had a very storied career. He's currently the head of macro at Fidelity International. He is previously a Ph.D. in economics from the University of Cambridge. And has had a very fascinating journey. So if we have some time at the end, we're going to try to unpack a little bit of his journey and a very interesting conversation on identity as well, if we get the time for it. We'll also take a lot of your questions towards the end. So please continue to share your questions in the chat as well. And then a quick introduction on me. My name is Bilal Lakhani. I will be your host. Today, I'm a columnist for the Express Tribune by evening and a storyteller and a communications director in the morning. All right, so let's get started. Salman Bhai, the first question that I wanted to start you off with, it's in everyone's minds. What's happening with the Russia and Ukraine conflict right now? We anticipate that there will be significant economic impacts of it that have already begun, with a lot of sanctions coming through on the 10th largest economy in the world. It's already creating an impact on oil prices. Can you unpack for us a little bit what you're watching in terms of macroeconomic trends that are going to emerge from this conflict in the short term to the long term?
Thank you very much, Bilal bhai. Thank you once again for having me, and of course, big thank you for the people to join us today. So let me start by saying first that, of course, they say that, as you rightly pointed out, I think this was a saying from Lenin you mentioned, which is quite ironic as well, given the role of Russia, but also that history may not repeat, but it does rhyme. So 100 years ago, we are going from war to plague. Now we are going from plague to war. So it's quite similarities with to our generations, which were probably thinking about these things. Hopefully not in the same manner, I guess, going forward in the early early 20th century. So how are we thinking about things? So as you rightly pointed out, Russia is the 10th or 11th largest economy in the world, around 3% of GDP. So it's not economically huge. The financial linkages of Russia with the rest of the world are also manageable. Just to put some specific numbers there, Russia's external assets are around 1.6 trillion, and their external liabilities are around 1.2 trillion. So Russia was a net creditor to the world. It wasn't borrowing money from the world like countries like US, China, US or Pakistan does. They were actually, like China, a creditor to the world. It's the external side of the balance sheet which has been locked up now by the West, around 50% of it. So around 800 to 1 billion to 1 trillion of Russian assets have been frozen. On the liability side is where we, the West, stand in terms of investments. So our thinking is that the losses are likely to be around $600 to $700 billion. Just to put things in perspective, that's around 0.6% of financial assets globally. It's not a huge shock beyond the immediate, issues when you really have to take those write-downs. So the write-downs are generally now to zero, which is also unprecedented. In the sense, like, index providers have kicked out Russia from the indices at zero price or very, very much at zero price. So that's is likely to be the the modus operandi going forward. So the Western system will take losses and price Russian assets to zero, which is from Russia's perspective, is their liabilities. So financially, they are not. It's not a huge issue. Where it becomes a huge issue is that Russia is a beast in commodity markets. So 10% of, I'm sure people must have focused by now that Russia is obviously 10% of global oil production. But in grains, they are much more. They are dominant. In gas, they are very dominant, not only globally but as in terms of the linkages with Europe. So around 40% of European gas comes from Russia. Around 51% of German gas comes from Russia. And a lot of these countries like Poland and Hungary are heavily dependent. So more than 75 to 80% of gas is coming from Russia. So it's a concentration risk. This is the commodity risk. So this is the way we will think about it. The macro commodity channel is way more important. And that means it's not a short-term issue. It's probably going to be a medium-term issue linked with how much disruption we get in commodities. So the template we are using is the 1973 oil embargo, where around 16% of global oil supply was disrupted for 7 months. Russia is around 10%, but of course, gas is a real question in there as well. So it's a good template to have, and it is stagflation shock because commodity prices will go up, likely to remain high going forward. Of course, a lot of uncertainty, volatility, but hard to see why the risk premium will come off given the situation on the military side of things. So that's how we would think about it. It's a stagflation shock. Interestingly, again, history repeats itself, but history rhymes, but probably not repeat itself accurately or to the last decimal place. But one scary statistic I saw was that that inflation number in the US a month before the embargo was 7.2%. And right now we are at 7.9% going into the shock. So it was already a higher inflation regime when we went into oil embargo. It was a collapse of the Bretton Woods system at that time. It was a world in flux, and the pandemic has put us into a proper flux as well. And one of the results have been higher inflation. So this shock is really for the US an inflation shock. And for Europe, it's both inflation and growth shock, potentially a severe one if gas is disruptive. So all in all, this is stagflation, not an historical environment which has been good for asset classes, and this is something which will depend on obviously a lot on the military side of things and how much disruptions happen. But commodities is the way to think about it rather than the financial linkages with Russia.
Very interesting. And then since you've spoken about sort of the impact that it may have on the US, let me sort of come to that. Another thing that's happening in parallel because of inflationary pressures that were already there in the US is the Fed is about to raise rates, and the era of easy money or quantitative easing is sort of coming towards an end. How are you viewing the Fed in terms of your outlook to be able to raise rates, and how much do you think you're seeing in the next year or two? And two, do you think the Fed can manage this well without sparking a recession, or is there a danger of making mistakes when it comes to expectations here?
Thank you, Bilal. So I think the mistake was already made last year. The mistake was that there was an unnecessary fiscal which was done when the Biden administration came into power. By that time, it was clear that the COVID shock was not as severe economically as we thought in the dark days of March 2020. The vaccines came on board much quicker than anybody thought at that time. So that fiscal stimulus was a huge demand source and came at a time when supply side was under pressure, and that created that inflation dynamics. It was a mismatch between demand and supply. And the Fed continued to print money through it by adopting this transitory word, which they have retired. So the Fed's inflation forecasting is pretty bad. I think even an undergrad economist can do a better forecasting from the Fed. But there are issues why they have to do that. I mean, there are institutional thinking behind where they mark inflation. I won't even call it forecast. It's what they want it to be. Which is a bit different. So coming to this shock that they were already trying to make a U-turn early this year, trying to get on hold of inflation because inflation expectations were starting to rise. And that's where this shock has come at a very bad time for them, because stagflationary shocks are not very easy for central banks to manage because they are supply side shocks. Monetary policy that itself cannot tackle it. The only way monetary policy can tackle is by, as you rightly pointed out, by tamping on demand. You do it too much, you get a recession. So in this case, our view is that the Fed will be a bit more cautious. They will probably hike 3-4 times, not the 6 or 7 times the market has been talking about, and probably start to hike in 2023 more so. So do a more longer hiking cycle rather than upfront, like they were trying to think about it in Jan, just to shock the market into that we will fight inflation. The reason is that Europe is going to seriously face a growth shock. Our base case is European recession now, and the US can as well, if the Fed doesn't pull back from aggressive hiking. One thing I'll mention is they've already pulled back from this 50 basis point nonsense they were talking about, because that was never helpful from a macro perspective. It was only dramatics if you think about it. But it's good that they are now focused on a more gradual pathway, given the uncertainty and the fact that there's a lot of volatility and uncertainty.
In some ways, the Russia-Ukraine conflict may just have prevented more dramatic action by the Fed, which could have actually sparked something even worse. So now we're going to come to a question that's very close to the hearts of a lot of people in the audience here, which is, how does these macroeconomic trends, particularly the Fed's decisions, how they will impact startup valuations or unprofitable tech? There's a big startup community here. And actually, I want to give a big shout out to Park Launch and Ali as well, because typically we'd see you on CNBC. So we have you exclusively here to be able to converse with you on this and also answer some of the audience's question on this. But essentially, we've seen a lot of money flow into startups, into new things, into crazy things. We've also seen a very small sliver of that money trickle into Pakistan also, but it is significant in the Pakistani context. However, we see sort of tech wobbling. How do you see this macroeconomic environment shape tech valuations, shape sort of the money that's been flowing into startups?
So I'll try to answer this question in terms of what to watch for. So when we are thinking about asset allocation, and then of course the VC side is where our linkage to startups come through. So the baskets we watch are unprofitable techs, or ARC ETF is a good example of it. That's where your proxy lies. How exuberant people are about technology companies who are making no cash flow or profits. I'll be upfront about it. We got completely out of it many months ago because we thought these numbers don't make sense. There's a limit to how much we believe and trust people in terms of what they're saying. And there's a valuation argument which came into play, right? And we have seen this story many times before, people losing a lot of money out of it. So as investors, it's our job to be skeptical, frankly speaking. We have fiduciary duties, which we have to fulfill. An environment where the real rates are going up or the Fed is more hawkish is not an environment from a valuation point of view which will be supportive. And I think that euphoria is over. A lot of that had to do with the fiscal stimulus checks which people had, and how that transmitted through the system. There is a money volatility, velocity effect also coming through, and we saw some exuberant behavior both in public listed markets and obviously the unlisted market segments. But that segment started to come under pressure a few months ago. So if you look at ARC fund, it peaked, if I'm correct, maybe September, October, or maybe a bit earlier than that. So that was the peak where the exuberance was coming through. So you would expect from that market behavior perspective, the valuations to go lower now. But also that cycle where people become much more nuanced and good ideas get whittled down from bad ideas. And doesn't mean a bad idea is that your idea is bad. It's that, business is a risky proposition. A lot of things can go wrong. These are a lot of idiosyncratic risk factors which may not be in your control. So it's not just skill. So we need to think about, that's why investors have to spread their bets, right? That's the thesis of diversification, not to put your eggs in one basket. So it's going to be a tougher environment from a macro perspective. But having said that, if you have a genuine good idea, you have and you have targeted market, you can basically convince your investors. Then I think that structural asset class is open now. It's the valuations which will now people will play with. That okay, maybe this is not as lucrative as we thought, but that first step has been taken, so that Pakistan is ready to do startup and understands the startup fundamentals, how it works. But I think the good days from a valuation perspective are over. Another thing I would mention is this is a lot of time commitment and career commitment. Not all ideas will work. This is unfortunately the law of how businesses work, and this is people like me's job to remind people of that, that you have to be tough on yourself and tough on the idea which is coming through, because this is a proper commitment and you have to do all your risk reward analysis when you're doing that. So ideas, you have to be, basically my point is that you have to be more brutal on your ideas. So basically I was just looking, just one example, somebody made some children rhymes and put it on an app. Now you can't have a 50,000, $5 million valuation on something I can go and watch on YouTube. You see my point, right? So the fancy stuff has to come down. You have to basically solve real problems, and through that, where's the cash flow projections? And I think the investors will still be open, and they've seen how success happens, right? So that has not gone away anytime, and it's not going to go away anytime soon either.
Absolutely. And, even though I think you've broken some hearts with that answer, I think it's better to hear it from you than to experience it. I think in terms of how startup valuations will play out, it's also sort of a momentum thing. It'll be very interesting to see how, when the momentum shifts, how that shifts people's perspective, because, we saw a groundswell of change where, both of us have graduated from LUMs. We typically would think of, joining and having a corporate career, but these young kids were like, oh, I want to start my own startups. And as these valuations change, it'll be interesting to see how that dynamic plays out as well. I want to move to another unpopular discussion, which is on inflation. How are you viewing sort of inflation and inflation expectations in the US and around the world over the next couple of years? We'll get to Pakistan in a bit, but just want to understand from you how you view inflation in the short to medium term now.
So just as a rule of thumb numbers, if oil prices go up by 100%, you do get around 150 to 200 basis point impact on inflation in the developed world, mainly on US, and probably higher than Europe. So already we are at 7.9, so it's possible that we have a high 9% handle in the next couple of months. Ultimately, the headline inflation will depend on where oil goes and where it settles. But our thinking is the oil will settle at higher levels than even today's levels. Russia is a big market to replace. Even if those barrels are replaced through OPEC or other countries, the risk premium needs to remain in place, because you are then exhausting the entire system to its bottom of the barrel, literally. Because Russia, just to give you a sense, it's around 4 times Iranian disruption. So it's a significant disruption. Now, critical question would be how quickly inflation comes down, and where does it settle? One should remember that it is in the interest of policymakers to run higher inflation, to take the value of debt down, so the real value of debt down. There has been a lot of debt which has been put in the system because of the pandemic. Now with the energy shock, probably more so, because you'll have to do fiscal stimulus for energy prices for the household sector. Is already happening in Europe. Will start in the US as well. Gasoline subsidies, if you will. So that will always be debt funded. So the institutional thinking is not to go down the path of wealth taxes to where it is always on income taxes. And another way to do an income tax is through to tolerating higher inflation. And we do think that ultimately inflation is going to settle higher through the incentivization of policymakers. But there are other forces which are like long-term forces like demographics, technology, or productivity gains, which in the last 20 years we know have been quite deflationary. But there's obviously a lot of evidence that is weakening. So globalization is reversing. Supply chains are becoming much more geographical or geopolitical angle of supply chains has become much more important, as you can imagine. These are all inflationary dynamics because now you can't go for efficiency. You need to go for risk management. And I think the analogy I give is that you have to now buy insurance, but these insurance are not zero priced. Like you have to pay something for your life insurance or your car insurance. It costs money. Mm-hmm. So that's the kind of insurance which will be needed in the system, which is inflationary.
And in this inflationary environment, where should people park their money or their investments in such, not just an inflation environment, but also so volatile, whether it's geopolitically, whether it's from an interest rate point of view? What are sectors that people should be investing in? Should they be getting into equity? Should they be, how should they think about allocating their investment, and what classes should they be thinking about?
Well, there is evidence that long-term equities do give you obviously return which is higher than inflation, so that's positive real return, and it's quite significant over a longer period of time. But the stagflation effect is historically has not been great for equities, and you're seeing those impact right now. Unfortunately, inflation environment is not great for bonds as well, and given that starting level of yields have been so low. So within equities, you have to think about companies who have pricing power, who can pass on that inflation, or creating real earning yields. So after taking into account inflation or where inflation settles down. So basically pricing power becomes a very important element in your allocation. It's also an environment where if you don't produce cash flows and you are selling expectations of cash flows, it becomes tough to do it because you have to then put a proper discount rate because of inflation. So the cost, when inflation is zero, you can literally wait, for a long time for the idea to come through. But when your cash is losing 10% per year, mm-hmm. The impatience, the system becomes impatient. They want things now, and that's mm-hmm. very bad for long-term long-term cash flows which are not immediate. So that's the kind of environment we see historically has been playing out as well in a big stagflation environments. If this settles, then yes, you'll have to have a proper shift in your styles. And then, of course, as I mentioned, the pricing power element comes in. Gold is another one, which I think is proving that it's at least being a safe haven in these volatile markets and geoeconomic uncertainty, and I'll take notice of that.
And then, you talked about equity and bonds and how, they get impacted during inflation. One favorite asset class of Pakistanis, whether they're in Pakistan or abroad, is real estate. It feels more real. And the last financial crisis was also a real estate driven sort of crisis, the subprime mortgage crisis. Just curious to get a quick pulse check from you. Is real estate a fair enough class, whether it's in the US or in Pakistan, to protect in these inflationary times?
Real estate actually is, as you said, real assets, so it has inflation fighting capabilities, and in the developed market goes through the inflation linkage of rents. So rents start moving with inflation, so you have real protection on your income. But it doesn't mean that real estate can continue to go up, because then you have also macro volatility, and because of the role of leverage in real estate, it becomes a cyclical asset class. Mm-hmm. But I think compared to the subprime era, real estate is much more buffered, because the upfront deposits, for example, in the US or in the UK, are much higher now than they were in 2007, 2008, and people's mortgage books are longer locked. So there not a lot of people are on variable rates. So if rates go up, it will be a delayed effect on real rates, on real estate. Leverage is the critical issue at some stage, but the inflation linkage of rents does play out. So it's a more nuanced picture on real estate than 2008, 2009, which was a deflationary shock. So rents collapsed and prices collapsed. So in this case, I can tell you from UK, the rents are going up, 10, 15%. Similar story we get in the US because there's this fundamental shortage of housing in both UK and US, and now apparently and more so in Europe as well. So when it comes to Pakistan, I think Pakistan real estate has been linked with the dollar, and it has become a hedge against local inflation. Because that's the first port of call for foreign investment, which comes to Pakistan mainly through Pakistanis. So their behavior basically links real estate to dollar and indirect inflation hedge. As long as they believe in it, it will continue to do well.
Awesome. So with that, let's come to then Pakistan. We see the macroeconomic sort of shocks that we're currently experiencing. Your outlook on oil is actually very depressing for Pakistan, but curious to hear your perspective on, how you view Pakistan's economy being impacted through some of the macroeconomic trends that you're seeing in the next year or two.
So commodities is the main channel. Pakistan is a commodity importer. It's a terms and trade shock against Pakistan. So we'll have to pay the cyclical price of it. When you don't prepare in good times and when the bad times happen, you pay the price. That's what the old wisdom says, and that's what's going to happen now. Our balance sheet is not strong enough. So balance sheet is not strong enough to take external shocks, but the world is going through shocks, and this is a very good example of a shock, and the pandemic shock, which we had no control over whatsoever. But where we have control over is to build a balance sheet, or sovereign balance sheet, which is strong enough to take these shocks if and when they arrive. So unfortunately, it's going to be tough times for Pakistan till oil settles at its new steady state. This is a major disruption in the oil markets, and Pakistan doesn't have much storage, so it's not like they can smooth over their consumption. Wheat is another one. Food prices going up. So I think Pakistan is not massively short of volume effect. Like countries like Egypt or Bangladesh, they potentially may not have supply of proper grains. Because remember, Ukraine and Russia are major players, and Ukraine is completely offline. But Pakistan will see the food inflation part. This is a tricky time for emerging markets. If you remember, Arab Spring was triggered by a very sudden increase in food inflation. So we are worried about certain frontier markets where food inflation can actually, expose underlying fractures in the country. So it's going to be a tough time for prices, but I think what saves Pakistan is that we're not a major importer of food. I think countries like Bangladesh or Egypt, for example, are much more exposed to volume disruption. No matter what the price is, you won't be able to get wheat because there is enough around. So that's something I think probably is a positive factor. Or in the short term, in the next few months, it is going to be very, very inflationary for Pakistan.
So primarily you're saying inflationary impact, and then that could potentially, if we're importing expensive commodities, it could also have a depreciation impact. Do you see any chance of a sovereign default risk for an economy like Pakistan in sort of an environment like this?
It certainly puts pressure on the sovereign balance sheet because, as you said, you have to then take into account high expenditures on commodities which you're importing. Pakistan's starting position is weak given the very high debt to burden ratios, already wide accounts, even when there's no commodity shock. So your starting levels are very wide. Now the question is obviously the IMF program and how you you deal with that. That's both economic and political. It has always been that way. It will always remain that way. So you'll have to have a view on, that interconnection between Pakistan and IMF, and if how much they will give you leeway to absorb this shock. Yes, you have to be careful that all of a sudden you have a significant reduction in terms of trade, and then you have to have a view on the politics of your reliance on IMF.
Okay, I have a couple of more questions, but there's an interesting question from the audience that's related to what we're talking about right now. So let me ask, is there any way Pakistan can take advantage of this global macro investment environment? I know we've been depressing a lot of people today. So is there any sort of upside that Pakistan could potentially tap into if there is a sort of an inflationary environment? Is there a chance for us to be able to get more export earnings? If there's more geopolitical tension, is there any window of opportunity here that Pakistan should be seizing?
I think the window of opportunity is that we should not be opportunistic. We should seriously think about a strategic work on our strength and not look at the hit and miss which comes into every situation. The military, power we are is not a result of an opportunistic thinking. It's a result of strategic thinking. If we are going to become economic power, then we need to start thinking about strategic. This is a pure commodity shock. Anybody who basically buys oil and buys food is going to be in trouble. There's no opportunity here. It's actually, we should be thinking about what we did wrong to get into this situation in the first place. There are major shifts going on in the world economy, and Pakistan has to increase its share of exports and diversify its base. But that I have been listening to that for 20 years plus, hasn't happened yet. I don't want to be depressive, but the thing is, it's also a function of mindset. When we say, "Oh, let's take advantage of the next 6 months," that doesn't work for Pakistan. You're too weak for that.
Yep, truer words have not been spoken. All right, so speaking of trends, let me then come to another question that I wanted to ask you, but there's also somebody in the audience who's brought up the same thing. What is your view on cryptocurrencies, and could it have any impact on the global economy if there's sort of significant volatility there in the coming months?
यार आप मुझे बिल्कुल सारे नेगेटिव क्वेश्चंस पे डाल रहे हैं क्योंकि I am a skeptic of
We should have talked 3 years ago.
Generally, is another one which I've been warning people about. But don't listen to me. You look at the behavior of cryptocurrency in these environments and then make up your own mind. This is the kind of environment it should be performing. That's one point. The second one is that decentralized financial system has a huge issue in terms of its thinking. Why would a government give up its power to control the financial system? Any country which gets into trouble, the cryptocurrency can open a capital account for them. Why would they allow it? You have to answer those questions. Why would the governments at some stage allow this? I can't answer that question. I put myself in their shoes, and I think that this does more damage than good, and it's very easy to kill. It's instantly you can kill it. But again, what I do recognize is the technological innovation which has happened. It's significant. It's a quantum leap in terms of thinking and its applications. And I think we should focus on the technology rather than that application. There's a huge ecosystem being built, which I think will be the bedrock or the backbone of the financial system of the future. So you have to be a bit more nuanced about it. And I think hopefully the debate becomes more mature rather than this being a betting tool. And I think speculation, yes, some people do take advantage of it. But if you look at the numbers, 99% people don't take advantage. Otherwise, the gambling companies would be, a lot of people would be much richer by gambling. So those numbers don't tally up. But the real innovation, the real productivity gains, there is technology there, there's an ecosystem. So you have to think about where you are in that chain. The gold rush will be over at some point.
Absolutely. But the one thing that cryptocurrencies and even this Russia-Ukraine conflict signals is the world is sort of there are certain systemic risks that we have questions on but not answers. For example, the level of debt that the US has, the power that the US dollar has in the world today, the fact that now we don't live in a unipolar world where China sort of begins to emerge, Russia begins to sort of overshoot, but just also try to assert itself. In this world, your position on crypto is very clear, but do you see a systemic risk of, say, let's do it one by one, but say, with the power of the dollar, with the kind of debt that the US has, do you still feel there is no alternative to sort of the dollar and the world that we see it today? Or do you feel like the debt is a significant concern? Does it keep you up at night, or do you feel like the US debt and sort of the systemic risk is not something that keeps you up at night as much?
The systemic risk and the debt ratios are high, but there are ways to bring debt down. So this is after World War II, we had debt ratios which were as high, but yes, there was a difference. The demographics were much younger. You had capital buildup which happened on the back of it, so that helped bring debt down. I think slightly higher inflation is one solution. What is happening with the usage of sanctions and how far and deep they have been does raise a question about dollar's long-term reserve currency status. But we live in nation states world, and that has a profound meaning, which means that reserve currencies have to be backed by military power. That's the reality.
All right. You've said a lot without saying much, which is why you're in the role that you're in. Let me ask you then another question that's come in from the audience. And this is more to dial up, sort of double click on your perspective on Pakistan. What kind of monetary policy, fiscal policy, and structural reforms can support stronger and more sustainable growth for Pakistan? You talked about not being opportunistic, but how do we go and think about this more strategically? I guess this is the original sin, this question, asking this question, but let me ask you anyways.
This is basically, there's no rocket science behind it, in the sense like it's a very straightforward problem. It's basically a question of will. Are we willing to do it? So we have several models now in the last 60 years of countries who started behind us in economic prosperity and have surpassed us. So you have the model of Southeast Asian countries, Korea, obviously. You have the models of countries which came out of the ruins after World War II. So we have to think about our geopolitical and geoeconomic situation. We say the word geoeconomic, but I'm yet to come across like a proper, well thought out Pakistani version of geoeconomics. Right? Geoeconomics, you can't just steal terms from the West. We have our own context. So I want to understand what is the Pakistani context of geoeconomics. But we do have to think about the balance between self-reliance and the external sector. We have to build, even that if that means short-term pain on the growth, a sovereign balance sheet and proper reserves. Because that is the backbone of any economy. And even if that means short-term, we have to give up growth. And we have to go against, vested interests. Because once you have a strong spine, you can take the shocks like the ones we are experiencing right now and be able to give the stability for businesses to plan on the long term. Right now, our businesses are basically content with doing small things. They do not think about going big outside. Commodity mix or product mix of Pakistan has not increased massively on the export front. So we need that baseline stability. And other countries have done that. You have to look at, as I said, Korea, Japan, Germany, they completely destroyed after World War II. and they came through. And then our linkage to China, which is the next economic superpower, is already a very big economic country, but it's on the path to be a proper economic superpower in the next 10 to 20 years, with a big rise in their consumption. Demographics of China are on a decline. Our demographics are fantastic for the next 20 years. So we can't be providing 20% of certain markets of Chinese consumption. We are their neighbor, like the Canada US model or Mexico US model. We can't build it up with such a big economy on our doorstep. But it requires long-term gain and short-term pain, and somebody has to take the short-term pain.
Absolutely. And we've avoided taking that short-term pain for around 70 years now. So, and in the long term, we're all dead. So, all right. Two questions that are coming that are similar. So let me ask you on this. People are essentially asking, the supply chain driven inflation makes life very difficult for central banks in terms of choosing the best strategy. And they're asking your recommendation for the best strategy. And they're also asking, like, what are signals that you will watch to know whether the central bank and the Fed is managing this well, or whether they've begun to fall behind the curve? Like, what will you watch to be able to tell whether the Fed is doing a good job or not?
So we have to watch real rates very closely in the US. They once again start falling after the Ukraine war started. We would expect that real rate to stop decompressing. It's already -1. It went up to -50 basis point when the Fed made that hawkish pivot in Jan. That is a critical indicator from a macro perspective, whether the Fed is, where is the Fed in terms of his thinking. We've already seen the ECB still be hawkish, despite the fact that Europe is, at the forefront of the damage. So we think that they will have to make a U-turn on that front. So real rates and the shape of the treasury curve, if you are looking into it deeply, that's the two indicators we watch very closely.
All right. What is your outlook on emerging markets in this macroeconomic context? And if China continues to prioritize regulation over free markets, this is a question that's coming in, how do you see that impact sort of China's position in the global economy?
So China has certainly been very aggressive on the regulation front. It's still ongoing in the background. There are some areas of China equity markets we have identified we think have value after the spillover effect which happened last year. China government bonds have been a very significant source of store of value in dollar terms since the pandemic began. So it's a good diversifier. And the renminbi has been quite stable during the different shocks. There are certain parts of Chinese equity markets which are under constant pressure of regulation or threat of regulation. So we are now focused more on the consumption side of things. Where is the China economy will look like in the next 5 years or 10 years, and the rise of that consumer, the China consumer. So that's what we are focused on. Yes, there are certain names which are too big to fail, which have been mapped out as national security or whatever, which you need to be thoughtful about in terms of long-term investment. But it's not a signal for the entire market. If you see my point, China is a big economy, complex economy, no doubt about it. But if you look at, for example, China government bonds, they have been the best. China government bonds have been the best performing bond markets in the last 2 years. Have outperformed US by a margin, whilst the high yield property segment has been under pressure because of obviously the regulation. But then there have been spillovers in other sectors which we think doesn't make sense. So there is value there, but you have to be much more nuanced and much more careful about it. And it's, frankly speaking, a full-time job.
And is your outlook similar on emerging markets more broadly, which is you've got to pick the winners from the losers? And
commodity price changes are net bad for EM, but bad for commodity importers, and it's great for commodity exporters. So South Africa, LATAM are in a better position right now. I think some parts of the commodity exporting markets are a bit expensive, like Saudi, for example. But the ones who were under pressure last year, especially the commodity exporters one, are the ones we like this year. Once the risk aversion settles down and we have a steady state on commodities, will be visibly higher than what we had in Q4 of 2021.
Wonderful. I want to take a few minutes to talk about your personal journey and identity as well. It's interesting, before we had this conversation and we were talking yesterday, I compared you to a white guy. I compared you to Ian Bremmer, and I said, you're going to be Pakistan's version of Ian Bremmer, and you didn't like that because you talked about, how identity is important and how, you've been on a journey yourself with it. Could you talk a little bit about, your journey from LUMS to where you are today as a Pakistani, as somebody who's in the UK, as somebody, who, when you talk about sort of your recommendations from Pakistan, you're talking about how to become more sovereign, how to become sort of our own, and where there should be linkages and where there shouldn't be linkages in terms of economic models with the West. Can you speak to your own journey and your own process on identity and where you are today, and how you see that reflecting back on how we structure our economy and how geopolitics plays out? It's a big question, but take your time.
You're linking it everything with everything. I guess at some stage everything is linked up. I think the first thing I would highlight and share is it is like you, Bilal. I was at LUMS. I left in 2000 and then came here to do my master's, and then started working. Then did my PhD and so on and so forth. So it was in that sense quite a linear projection of where we were in 1999, 2000, which probably was approaching the peak of globalization. So economic migration was incentivized, was easy. Please remember that it was not just my merit or my hard work or everything which contributed to this journey. Please remember the context. I was sitting there in 1999, 2000 in LUMS. At that time, there was no national outreach program in LUMS. So you have to have minimum income of your parents to be able to go into LUMS. So let's not forget those things. So maybe a person who had the same skill set I had in a lower income cohort, there's no way that journey could have started. So we have to give credit to a systematic factors, as we call them, in macro, because we overestimate our own skills sometimes. So the starting points matter. So that was what was happening in Pakistan at that time. It's good that LUMS started this national outreach program, because I think we have to level up opportunity. At that time, it was not the case. So people in my batch were similar to myself in terms of the income of their parents, where they were coming from. So that's one factor. Then the other one was that the West was accepting talent, demand and supply. Mm-hmm. If you are willing to supply hard work, somebody needs to demand it as well. So we passed through that. I think globalization, I saw part of things, and this reflection came through when Brexit started, right? When then all that stuff happened in the UK, it hit you that maybe like people like me will not be able to have the same journey now, because the world is changing, the regulations are changing, and the context is changing. So that's something important to consider, and it's also a source of being humble about things. I think it certainly makes me humble about the journey I've had. So that's one point I would mention. The other one is, again, as you mentioned on with identity, is that we have to understand our own context, and the context and identity is a two-way street. It's not how we think about ourselves, but also the world perceives us as. And that perception has to be nuanced. I'm not saying that whether it's a wrong perception or right perception, you have to understand what that perception is. So people do make judgments, even if they are unconscious judgments, on the back of how you look. That's the way maybe human beings are wired, to make shortcut decisions. And maybe that's why people who are thoughtful and take their time to make decisions do better, because the instant the human wiring is of to make a decision on a shortcut, or what you call mental hacks. So maybe that's the reason. But having said that, those are realities, and we have to be aware of them. So in terms of your question on identity, so you mentioned, I remember this conversation obviously from yesterday. You mentioned Ian Bremmer. Firstly, I'm not even a big fan of him, but I understand where you're coming from that one. But he doesn't have that my upbringing, my experience, and my perspective. So I can't, I can't, as a role model, I can't see myself with him. I don't understand where he's coming from. So in terms of that, I've been thinking that, like I mentioned to you, Sir Syed Ahmed Khan, right? For example, I think he was a man with a vision, but also had his context and his identity, which shaped his vision. So he was talking about education at its basic, but he was also talking about how to reduce the conflict between religion and the pursuit of knowledge. What he was saying was that you have to go for knowledge and learn English, not to become Gora, to interact with the world. I think that was a very sensible way of looking at it. So I don't want to learn English, or my children to learn English to act like a Gora. It's to engage and interact with the world, because our identity is a function of both ways. So that's something, it's ongoing process and journey, but certainly, it goes back to the fact that we may think at an individual level, it's all driven by hard work and skill. Yes, it is needed, but the macro factors, let's not forget that they can be very powerful.
This is fascinating. And actually, this is why interactions like this and Park Launch has such a unique space in the ecosystem, because you get, the problem with having brown role models or Pakistani role models for that matter, is you can't see them. They don't have the visibility or the platform, even though they are now increasingly in those positions. And so it's important to be able to create spaces like those and conversations like this. I could talk to you about identity for 6 months, but I think the audience will want us to move back to the economy. But it's an interesting sort of insight. One tangent that's sort of more related to economics, but still on the identity vector, is the fact that a country like Pakistan also adapts economic models from the West, and tries to use the same template for growth, versus sort of indigenous research and indigenous understanding. So much so that even when COVID happened, and it was about lockdowns, without contextualizing sort of whether that was right for emerging countries or countries like Pakistan, there was so much hysteria and pressure from the elite to just take what was being done in the West and sort of use it. How do you, think about this, or what is your advice to sort of Pakistani policymakers when so much of our system is already sort of interlinked with the West, and when there's so much of an IMF sort of dependency? How do you even begin to build your own indigenous way of thinking and build confidence that this is the right way to sort of imagine and think of different models without going full Putin?
Look, I think Pakistan, the three principles I think Pakistan has to remember. It's basically difficult to give solutions when you don't understand what the problem is. And Pakistan's problem is long-term economic stability. It is not the next quarter and the next month's export number remittance. We have to zoom out. Just compare yourself with Bangladesh 20 years ago. You have to understand the power of long-term economic stability and economic modeling. The principle where we think we should question the West's prescribed methods. By the way, IMF has changed its thinking many times over the last 20 years. Like 15 years ago, capital controls were like a sin. Now they are accepted in certain conditions. So please remember that these are not Gospels and Bibles. Or Quran in our context. So the first thing is that Pakistan has to think about, as I mentioned, a target variable that our reserves should be X billion. How are we going to get there? No matter the pain it happens on the economic front in the short term, growth, blah, 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 that should be your target in the first place. Get your baseline stability, then we'll talk about, एग्जाम्पल ये है कि फरारी लेनी है, घर में खाना नहीं, पहले घर में खाना लाओ फिर फरारी की बात करेंगे. अदरवाइज इट्स अ कॉन्टेक्स्ट लेस डिस्कशन. पीपल विल से कि भाई कि आप नेगेटिव हो रहे हैं, वो प्लान, आपका क्वेश्चन ही गलत है. जब आपका घर में खाना नहीं है, आप मेरे से फरारी की बात है, आप कह रहे हो मुझे फरारी बना के दे दो, भाई खाना नहीं है आपके पास, हमारे पास, आप फरारी आप लेने की बात करें.
Bilkul, bilkul. And that's also a function of, they're not just being one Pakistan and two Pakistans, and some of them have Ferraris and some of them don't have food, and who gets the voice and who gets the mic.
And this is not a Pakistan issue, right? I mean, inequality is not a Pakistan problem. Yeah. And the countries with inequality have done better. China has inequality has increased, but they have pulled in, hundreds of million people out of poverty, which is quite noted in our political circles. But there's a way they have done it, and there's a method to it. This was not done by saying that this has been done. There's a method to it, but we need to understand a Pakistan-centric method which will work for Pakistan and the work for Pakistan's realities. And you can't just sport stuff without context.
Absolutely. So maybe we'll have time for one or two last audience questions. So I'm going to try to sneak them in. One question is, will the Russia-Ukraine conflict cause a major global recession? I think you've indicated that Russia is not sort of big enough in and of itself, but curious, like if you do see a recession on the horizon in general with everything that's happening and with the risks of the Fed and inflation as well.
So our base case is that Europe will have a recession, and the depth of it will depend on whether gas supplies are disrupted or not. There's a high risk that gas supplies to Europe are disrupted, but of course this is a very volatile situation, uncertain one, and I will be the first one to say I'm not a geopolitical analyst, so you have to take it as it's given in terms of the short-term developments on a day-to-day basis. The second one is longer term for US. The US right now is a stagflationary shock. I think whether the US goes into recession or not, as we discussed Bilal earlier, it will really depend on how the Fed reacts to this shock. Whether if they go quick and sharp early, then yes, the recession probabilities will rise. If they don't, then the recession may come later. Ultimately, a recession will have to come to bring inflation down. So the question becomes one of timing. So the cycle has been very fast. We have burned through the cycle quite quickly. Is because the COVID shock was so sharp and the policy response was so sharp. So what we accomplished over 2 years, usually economies do over 5 or 7 years. So this is a fast forward cycle. So you have to think about the timelines a bit differently.
And do governments and policymakers have anything left in any dry powder left in terms of interventions if a recession does occur, especially in the US, with sort of what we've, with the debt and with sort of the fiscal spending that Biden administration has been doing, with sort of the relaxed monetary policy that has been existing? Will that be sort of a painful recession, bordering on depression, or are there still sort of ways for governments to be able to manage a situation like that?
I would never underestimate the power of the state. And they have shown it again and again. Never underestimate the creativity of central banks. I think fiscal policy will become more active. You will probably see much more targeted measures. I think in COVID, money was given to everyone. This is probably, you're going to see much more income related distributions. For example, energy payments which are happening in Europe are very much income driven. You'll probably see that in the US as well. Why give $100 or $200 subsidy to a billionaire type thing, right? Because inflation is an aggressive tax. Inequality is pretty high. You potentially see inflation exacerbating that. Inflation of 10% doesn't affect a billionaire. It does affect the low income very much. So that's why inflation is such a politically charged variable. People used to think it's an EM problem, but now it's a DM problem as well. And it's an equally charged variable in the DM world as well. So I think the fiscal policy will become much more focused and effective in terms of effectiveness, in terms of what they're targeting. monetary policy will have to then take a backseat. They already did in the COVID crisis. I think another question for them is, are they going to run inflation hot while this is going through, or they're going to take the risk of a recession to make sure that inflation doesn't get out of hand? That's the question they will have to answer, I think, in the next few months. We'll probably, I think right now they have this option value, right? Because we don't know what's happening in the Ukraine war. We don't know where it's going to settle. So you can always talk that, okay, we need some optionality, which is, by the way, the sensible thing to do because there's a lot of uncertainty. But ultimately, the question is that fiscal policy will become more supportive. The question mark in my mind is that whether monetary policy will support fiscal deployment like it did in COVID or not. If it doesn't, then we are in trouble from an asset market perspective.
Wonderful. Well, thank you so much for such a riveting, insightful conversation. I think we all learned so much from you. So this was super helpful. And I wish, Ali Bhai, we need to have an identity conversation with Salman Bhai as well. But this was fascinating. Thank you so much for your time. And thank you to the Pak Launch team and all the guests who joined us today. We really appreciated your questions and this conversation. Thank you, and looking forward to seeing you in another Pak Launch webinar very soon.
Thank you. Thank you very much.